Hello everyone, how's it going? For those who don't know me, I'm Toby Hilton, and this is a quick walkthrough over the assignment for this week. What I'm going to be covering is question 6 from our quiz access this week over chapter 3. Question 6 isn't anything complicated. It's nothing that we haven't done before. There's a few things that are new. One of them is that we're actually going to cover right now over depreciation. What does that mean? But aside from that, it's pretty simple. There's 2 questions that have to do a little bit of math, but aside from that, it's pretty straightforward. So let's just jump into it. I have all the answers here. I've done check your work. Unfortunately, I don't have any more for it because I've tried making this video a few times and I've used them up trying for each example. But we're gonna go ahead and just look at these. All the answers here you see, I already checked them, so they are correct. I'm just gonna explain a little bit about how I got them and why they're there. For number 1, as we read, this entry is depreciation on the company's wind turbine equipment for the year is $5,400. So depreciation is an interesting concept because it is the expense that must be, as I have written right here, that must be recorded like over each period or each year. It kind of reflects on the consumption or the use of equipment, and therefore it can include repairs, it can include a whole sorts of things. So when we're looking here from our options what to select, there's really only 2 that come to mind. Of course, depreciation expense and accumulated depreciation, and these are both for equipment. One big thing I always look for is if anything changes with the numbers that we are given. As we can see, 5,400 doesn't change anything. So you'll see for the remainder of the video, you can't see it, but I usually put these in first. Just one debit, one credit, and we know we're going to put debits before credits because of the explanation. What I put was depreciation expense as our debit and accumulated depreciation as our credit. The reason I did that is, our depreciation expense will increase. It is an expense, so, they have to have a normal debit. They have normal debit balances. As for accumulated, it was a little bit more clear to me because it can be counted as a contra asset, meaning it, will increase as a credit, but it would also be reducing the net value at the end of the day, because their wind turbine equipment is an asset. That's something that's going to help them. So that is going to turn into a credit and take off at the end of the day. Moving on, we have prepaid insurance account for the solar panels had $2,400 debit balance at December 31st before adjusting for the cost of any expired coverage. Analysis of prepaid insurance shows that $800 of expired insurance coverage remains at the year end. First thing I'm going to notice here is we got 2 numbers, so there's going to be something fancy to do here. That's just what I look for. With the numbers, I see that we got a $2,400 credit balance, but we also have $800 of unexpired insurance coverage that we need to do. So what we look at here is prepaid insurance is an asset, but we do have an insurance expense and we're going to need to subtract that. So take that 2,400, subtract it by 800, we're going to get 1,600. That's the first thing I did, put these in here. What led me to choose these 2 is prepaid insurance is our asset, but it has been decreased, therefore making it a credit, and that is to reflect that the prepaid coverage has been used. Runs at the end of the year, we're there, so we're going to show that it's there. As for insurance expense, it's a debit and it's going to increase because that's what we're paying. Moving on to number 3, the company received $4,200 in cash in advance for sustainability consulting work. As of December 31st, 1/3 of the sustainability consulting work had been performed. So we've received this amount, but as of the end of the year, 1/3 of it's been used. So we need to get rid of that and, journalize that. 1/3 of 4,200 is 1,400. You can do that on the math calculator. That's what 1/3. The way we get that is, we just times. You can put in your calculator how you want. That's how I did it. 4,200, you can times that by point. I'm going to make sure this is right real quick. Do it by, you multiply it by 1/3, and that's where we get it. Moving on to Y. What we see here is I put unearned revenue as our debit and service revenues as our credit. Why did I do that? Revenue here, has been recognized as a credit for services because it's been performed. It's been performed, and therefore, we need to make sure it's satisfied. It seems satisfied here, and that's why I did it. Unearned revenue, however, it's a liability, and it's got to be reduced when that service is performed. So that's how I got that. For number 4, it says, as of December 31st, $1,600 in wages expense for the organic produce workers has been incurred, but not yet paid. So looking at something interesting here, first thing, I see $1,600, no change in that. We know we're going to get $1,600. Nothing's mentioned that's going to change it. Plop that thing in, debits before credits. Looking at that, I had account wages payable below and wages expenses in our debit category. Why? I put wages expenses because it increases as a debit to match our cost. So it's got to increase. We know we pay our workers. As for wages payable, we know that's a liability. So it's going to increase credit, but it's to show that the company's obligation to pay its employees has been paid. They need to pay it since it has not been paid yet, but it will be paid. So we need to make sure that we record that because that is something that is going to be taken out eventually. We kind of see that with the next one. It's like that that it will be paid in the future. Like speaking of interest. Speaking of interest, it says as of December 31st, the company has earned, but not yet recorded, $440 of interest revenue from its investments in socially responsible bonds. The interest revenue is expected to be received on January 12th. Looking at this, pretty straightforward. What I had down as interest receivable and interest revenue. I didn't see any change here. So obviously we're going to put 440 first in credit or debit and 440 in credit second. Why did I put them like this? Starting with revenue, we recognize revenue as a credit because the company has earned the interest in the period. Still has to be paid, but we're interest receivable as our asset, it will increase because the company has a right and it will receive cash in the future. So we know they will receive cash in the future. And we know that the revenue, they have interest for that period. So it's kind of a win-win. But yeah, that's a brief explanation on how this problem works. Again, very straightforward. If any of you have questions, please just leave a comment on the video and I will get to you as soon as I can. And hopefully if there's a problem with my explanation here, hopefully I'll be able to explain it a little bit better there. Appreciate you guys watching and hopefully you do guys well on this quiz. Have a good one.